And we are live. So thanks for coming. I have never done a live stream before, so I apologize for any technical difficulties that might arise. Also, if I don't make any mistakes, I'm going to try to publish this live stream as a standalone video after it's done. And my comments have exploded with content related to Silicon Valley Bank and not hide anywhere on social media without people sharing their opinion on this topic. Now, my main problem is that so many of these opinions are anything but nuanced. And so through today's video, I'm going to try to put a balanced perspective on this entire debacle on the table. So I will start by just sharing my thoughts on the topic, my thoughts with respect to the entire situation, and then if there is enough interest, we can move on to questions and answers. Now, as far as the first part of what we're going to be doing today is concerned, it also has two dimensions. First of all, it does make sense for me to start by explaining what exactly happened, so the easy part. And then it's going to be time to move on to the second dimension, which this time around is ultra complex and ultra nuanced, or more specifically, where does all this fit in as far as the big picture is concerned? Is this going to lead to the Great Depression 2.0? Is it a nothing burger? It's a very difficult topic to dissect, but let's start with the beginning. So chances are that the overwhelming majority of people who are going to be watching this video never ever heard about Silicon Valley Bank. And that's because it's not exactly the type of bank that accepts mom and pop deposits, so to speak. To the best of my knowledge, it has something like 15 to 20 branches, and that is it. So you've never heard about it. It's an atypical bank, but when it comes to Silicon Valley, obviously, or broadly speaking, the tech sector, it is of vital importance. Now, where to begin chronologically speaking? I don't want to go too far back because then everyone's going to be even more confused. So it makes sense, I think, to start with the year 2020. More specifically, to another event, to another situation that people thought would lead to a Great Depression 2.0, or at least to a Great Recession 2.0, the 2020 COVID crash. Now, as we all know, with the immense benefit of hindsight, it did not lead to another Great Depression because central banks, but also this time around, very important, governments stepped in with significant monetary and this time also fiscal stimulus, which led to an epic bull run across sectors, but especially tech. So I think it makes sense to write this in a bubble. Let's call it 2020 free money. 2020 2020 free money. What did this 2020 free money lead to when it comes to tech? Well, obviously, it led to assets going up. And as a provider of vital infrastructure for this tech sector, Silicon Valley Bank went from roughly 60 billion in, let's say, 2020 to over 200 billion in deposits prior to the crash. Now, needless to say, tech, with all it encompasses, from various startups to crypto, you name it, was the main beneficiary of all this easy money. People were having a good time. People were making money. Everything they touched turned into gold. And now, fast forward to 2023, things have changed because we had, let's call it the 2022 to 2023 tightening In other words, the punch bowl got taken away, and obviously there are consequences involved. Now, I have a bit of a pet peeve with people who call the Silicon Valley Bank situation a black swan. Now, I don't know Nassim Taleb. I'm an economist. He doesn't like economists, so I don't think he's ever going to watch this. But I think that if he would be watching this, he would agree with me that it doesn't really make sense to call this a black swan because it's a white swan. It's obviously a white swan. Why? Well, think about it from this perspective. The main beneficiary of the easy money climate of 2020, tech, has become the main victim of the 2022 to 2023 tightening cycle. So why should it be considered a black swan when the obvious simply happened? Market conditions changed, and so those who were most favored by previous market conditions are now quote unquote victims. So a black swan, this is not. However, white swan as it may be, what happened was that a deadly combination emerged when it comes to Silicon Valley Bank. More specifically, two important things. So let's write this in another bubble: 2022, 2023 tightening. Now, for the purpose of this video, this tightening had two important consequences. The first consequence was that interest in the tech sector went down dramatically. So let's just say number go down when it comes to tech, okay? And what does this lead to from the perspective of the bank? Well, it leads to not enough new deposits coming in, and even more so, withdrawals going up. Now, as we all know, banks don't just take money and put it under the mattress. They do stuff with it. Now, these are highly regulated institutions, so there's, it's kind of well determined what they can and cannot do with money. But, to oversimplify, think about it this way. They bought bonds, okay? They bought bonds, mostly treasuries, but also like stuff like mortgage-backed securities, etc. They bought bonds, but they did so when interest rates were ultra low, when money was cheap, when the party was going on. And obviously, those bonds aren't doing great right now. Now, of course, we say this with the benefit of hindsight, of course, but this creates a problem if you have to sell them, because it's not that you're not going to find buyers for these bonds, for bonds that you bought when interest rates were much lower. You're going to find buyers from them, but you will not be happy with the price. You're not going to like the price at all. And so if you are not able to hold to maturity, and then it is what it is, if you're forced to sell, then you have a problem. And this is what happened with Silicon Valley Bank. They exhausted their cash cushion and had to sell assets. They had to sell these bonds. What did they do? Well, if my numbers are correct, and I think they are, but they're around the ballpark, they sold about 21 billion worth of bonds, but they took a $2 billion loss on them, so approximately 10%. So bonds go down to the tune of a $2 billion hole for Silicon Valley Bank. Now, what did they do when it comes to that hole? Well, they obviously tried to raise money by selling shares, but I mean, I'm not going to buy any. You're probably, who are watching this video, you're probably not interested in buying any either. And so that didn't work. The next step is trying to sell itself. Okay, but who wants to buy it? It's or don't get me wrong, I'm sure there is interest, But selling it on short notice in a way that makes sense is easier said than done, and they weren't able to pull it off, so regulators had to step in. Now, as you know, just like over here in the European Union, in the United States, deposits are guaranteed. They're FDIC guaranteed, but there's a catch, and unfortunately, it's a game-changing catch for the customers of these banks. Because yes, deposits are guaranteed, but they are only guaranteed up until $250,000 in the United States. So, one, if you have, let's say, $100,000 deposited, you're going to get your money on Monday, most likely. If you have more than that, well, then it's going to be complicated. And while given the nature of the assets they invested in, you're not going to lose all your money. You're definitely not going to lose all your money. On the contrary, you're going to make most of it back. But the question is when, the question is under what circumstances, etc., etc., etc. So it's problematic. Now, the overwhelming majority of deposits at this particular bank were in the second category, because we're not talking about mom and pop depositors who had $25,000 or $50,000 in savings. No, we're talking about tech companies that deposited a lot of money there, thinking, it's all going to be fine. Tech companies that now have to pay employees, or they have to make payrolls, tech companies that have to pay the other companies they do business with, companies which themselves are relying on that money to make further payments. And so it all has a cascading effect, obviously. The question becomes, and I think it's now time to transition to the second part, the way more complicated part. The question becomes, the elephant in the room is whether or not there is going to be contagion. Now, this is a very sensitive topic, a topic that needs to be covered with the utmost responsibility, and where nuance is the operative word. Because no matter what people tell you on social media, it's not at all simple. Now, I will say this. It is indeed true that whether we're talking about banks, whether we're talking about the financial system, or whether we're even talking about the monetary system, confidence is the operative word. And if confidence disappears, then you are in trouble. And so, because as I've mentioned previously, this is a bank that most people never knew existed, the question is not so much, oh, what's going to happen to this particular bank, a bank ranked number 16 in the United States? No, the question is more so framed as, will there be contagion? Will this number 2 bank collapse after Washington Mutual post 0708, will it lead to contagion? And now we're going to move on to the very, very, very complicated part. Now, as I've mentioned at the beginning of the video, whenever you analyze something ultra complex, it makes sense to, again, start by being grounded in beliefs that you consider set in stone. So I have 2 of these beliefs that I think are relevant. Okay, my first belief is that yes, tech is super overvalued. That's a core belief that I have. Another core belief that I have, this time not pertaining to one sector, but rather to the system as a whole, is that there is too much debt in the system. Now, I have literally, and I'm going to plug it here, I've literally written, you could say, the book on these topics. Like my best-selling book of all the books I've written is called The Age of Anomaly. And in the chapter that tends to be the most popular one among readers, I take people from the tulip mania all the way to the to the Great Recession and even more recent calamities. I take people one financial calamity at a time, one economic calamity at a time, and I analyze it. And so I am quite familiar with these things. And as I've articulated in that book, and as I've mentioned publicly on this channel on multiple occasions, I am of the belief that this and this has to be resolved. I'm also of the belief that in order to resolve these two, pain will be required. I do not believe that it's possible to resolve them in a painless manner. There's just too much debt. There's just too much gross misallocation of capital in tech, but not just tech, in many other sectors as well. However, however, what bothers me about what I'm seeing in social media is that all of a sudden, everyone is Michael Burry. All of a sudden, everyone thinks I have it all figured out. I am the master of the financial system. They're going to make a movie after me. Everyone's Michael Burry. Whereas when it came to the 0708 debacle, no, for every Michael Burry, you had 10 people who made fun of Michael Burry, 10 people who were happily dancing around while the music was still playing, blissfully unaware that they are full on in a game of musical chairs. Whereas nowadays, nowadays, even when it comes to social gatherings, like for example, family reunions or whatever, it's surprising to me how many people are predicting a crash. Real estate is going to crash. Stocks are going to crash. A new Great Depression is going to come. It's very, very peculiar that nowadays, unlike 0708, everyone is now Michael Burry. Everyone is predicting the future. And I have a big problem with this because what did I say here? Nobody can predict the future. Michael Burry cannot predict the future. Michael Burry himself engaged in what I consider to be terrible risk management. But he ended up being proven right. He ended up making a lot of money. He was on interviews, etc., etc., etc. But to me, this is just a case of survivorship bias. You know, a lot of people took on risk in a manner similar to that in which Michael Burry took on risk, but they lost everything. You know, but there's nothing glamorous about interviewing someone who engaged in a trade that can be quite similar to what Burry did, but lost money. No, you're going to interview those who made it big. And so you're going to surround them with an aura of invincibility or this idea that, ooh, look, Michael Burry can predict the future. Nobody can, not even him, literally, nobody. And so, I'm sorry for this parenthesis. Upon analyzing so many financial calamities, I could not help but notice that we tend to be guilty of a recency bias, or in other words, you know, you had during the Y2K days, you had the bursting of the dot-com bubble, and then what was the next crisis? Was it another tech collapse? No, it was a crisis brought about by arguably the opposite of tech, real estate, you know. So to put it differently, we as human beings have a tendency of always wanting to fight the last war. So for people during the Great Recession days, the dot-com bust was so recent in their memory that they assumed the new crisis would be somewhat similar. It was not. At this point in time, the Great Recession is still too entrenched in our memories, and so we see Great Recession everywhere. We see Bear Stearns everywhere. We see Lehman everywhere. We see banking panic everywhere. And this leads us to suboptimal analysis because Evolutionarily speaking, humans are pattern seeking creatures, tiger, bad, chicken, good. These patterns have helped us survive for so many years. But in a world as complex as ours, they are oftentimes toxic to our decision making process because they make us oversimplify. And so, while I do believe that so much stuff is overvalued, and while I do believe that there is too much debt in the system, and while after drawing the line, I do believe the ultimate resolution is going to be ultra painful, one important elephant in the room in terms of question arises. When a lot of people were right about the global financial crisis, about the Great Recession situation. But unlike Michael Burry, they lost money because their timing was off. They did not answer the when question. The same way, how will things unfold? And let me just put it this way. In my view, if I had to guess, and again, I cannot predict the future, so I may very well be wrong, but if I had to guess, the ultimate end game of this entire situation is going to be inflationary. It's going to be inflationary. And so, for example, let me just give you an example. What if indeed all the Michael Burrys out there are right, and this is the big one, and this is going to lead to the mother of all contagions? And okay, then what? How do you position yourself? Because what if they're right, but I am also right when saying that the end game is going to be inflationary? And so you have the mother of all panics as a result of the current situation. But then governments and central banks step in even more aggressively than before. But this time they do so in a context of higher inflation and inflation expectations that risk becoming entrenched, and they lose control over inflation, with the end result being that what started as a deflationary, as a standard crash, so deflation 101, ended up very quickly transitioning into an inflationary spiral. And so if you audacious enough to believe that you can predict the future, sorry for being obsessive about this, but you cannot. You positioned yourself so well for deflation, but that deflation will be so short-lived that you do not manage to realize gains. And so what good does it do that you were right, quote unquote, if the hypothetical inflationary spiral that follows is going to catch you off guard? The things I say on this channel are not exciting. The things I say on this channel are not edgy. The things I say on this channel are boring. And I am begging you, when analyzing this situation, do so from a position of humility. Try to don't try to be the next person who predicted the financial crisis. Don't let your ego guide these positioning decisions. What do you want to do? You probably want to protect your family. You probably want to do you want to do what's right for the people you care about. Leave your ego aside. Everything that's unfolding is so complex that it goes beyond economics even. There is a full-fledged war going on in Ukraine as we speak. And there are any number of outcomes which could easily make people forget about Silicon Valley Bank just like that. Let me give you an example. Let's assume that the front collapses and the Russians just leave, and that's it. The front collapsed, they lost the war, it's over. I could easily see something like that leading to the mother of all bull runs that squeezes all shorts to infinity and beyond. And people forget all about Silicon Valley Bank. The same way, what if, heaven forbid, there's a nuclear exchange? And then people will forget about Silicon Valley Bank yet again, but they will do so for completely different reasons. Why? Well, because you're going to care much less about your portfolio and a lot more so about whether or not you have a proper shelter, whether or not you have canned goods in your house, etc., etc., etc. It's unpredictable. You don't know what the outcome of the war is going to be. You don't know how all of these factors that are in play are going to ultimately affect the end game. So why play this guessing game? You know, in my in my opinion, which is not the least bit sexy, which is not the least bit interesting. If by interesting you understand something that induces, that gives you an adrenaline boost, but just try to be protected across a wider spectrum of outcomes. It's really all there is to it, you know. There are people like Dr. Lacey Hunt, like to give an example of someone younger, Jeff Snyder or whatever, who are in the deflation camp, who, you know, more so believe that the end game is going to be deflationary in nature. I don't believe that at this point, but they might be right. They're smart people, whatever. So I definitely want to be prepared for a deflationary outcome, like the mother of all crashes, like Great Recession 2.0, like Great Depression 2.0. So obviously, I'm going to want to have an emergency fund. I'm going to have to make sure that my family can survive if indeed we have an ultra deflationary outcome. But at the same time, you have equally smart people who are in the inflationary camp. And so you don't want to have everything as an emergency fund. You don't have to go all in cash. No, you need assets as well. You need, you know, diversification across assets. It's not interesting. It's not exciting, but it's accurate, because unlike all these people who are chasing after fame or recognition or a book deal or a movie deal or whatever, you're at least starting based on strong, logically coherent fundamental beliefs, the most important of which being that you cannot predict the future. So with that stated, do I believe that there can be widespread contagion and that loss of control will be the ultimate outcome as a result of this Silicon Valley Bank situation? It could. Is it the most probable outcome? No. For example, I consider it a lot more probable that in the end, some kind of a quote unquote bailout will result, but not so much a bailout by the government or by the Federal Reserve as a long-term capital management style bailout, where you have market participants that they themselves bail out another market participant. So I consider, for example, a scenario like this one much more likely. Do I think you should panic? No, I don't think you should panic. Do I think you should prepare? Yeah, because I might be wrong. Why would you listen to me? Why would you listen to Michael Burry on Twitter? Why would you listen to Taleb? Why would you listen to Krugman? Why would you listen to anyone? Nobody knows, you know. People can be very creative at building narratives. People can be very, very creative, you know, across the board. But at the end of the day, literally nobody knows what's going to happen. And so, do I believe that this is it? Do I believe that the Silicon Valley Bank collapse is it? It's all over. Pack your bags. Deflation is coming. This is the big one. Personally, I don't believe it. Am I prepared to be wrong? Yes, I am prepared to be wrong. And if I am dead wrong, if it is indeed the big one, if it is indeed the crash of crashes that's going to meaningfully to meaningfully destroy everything, then I'm reasonably prepared. Unlike, people who chase after sensationalist headlines or whatever, none of my preparedness approaches is going to lead to me becoming filthy rich. I'm not going to become filthy rich. My goal is not becoming filthy rich. And if my goal was to become filthy rich, then the strategies I have would not be a good fit. No, my goal is simple. If I'm right, I want to land on my feet. If I'm wrong, I want to land on my feet. The name of the game is trying to put together a coherent framework that enables you to land on your feet. And I say this because it's extremely important to look beyond this particular event. Because while I am personally not in panic mode right now, when it comes to the ultra short term, I'm not in panic mode. I'm prepared to be wrong, but I'm not in panic mode. I am deeply, deeply concerned when it comes to these two things. Whether it happens next week because a deal cannot be brokered, whether it happens next month or next year, when it happens, I have several observations. One, I do believe that when it happens, it's going to be one for the history books. It's going to be a reference point, much more so than the Great Recession has been, much more so than the COVID crash has been. Number two, avoid Schadenfreude, or the idea that you're kind of like waiting for a crash to take place because you've been predicting it for so long, because it's going to feel so good, because everyone is unprepared, and so what if you're prepared? I can promise you that no matter how well prepared you are, there's a high probability that when the big one hits, whether if it's the result of events that are currently unfolding or something else, it won't be pretty. I truly believe that things can be so dire that people around you will become chronically depressed. You're going to have mental health consequences that I don't even want to mention on this channel. Don't delude yourself into thinking that just because you've read a few articles on the internet, or just because you've watched this video, or because you read my book, or because you read 10 similar books, it's all going to be great for you. No, when misery is going to be all around you, it's not going to be great for you. Number three, even if I'm wrong, yet again, and it's going to be great for you, and you're going to make money, well, guess what? Calamities of such nature give birth to the unpredictable, to conflict, to warfare, to social unrest, to a wide range of other things. And what good will it do if your trades ended up being very profitable, if the world around you, as you knew it, is burning? Okay? So this is my main message with this video. The idea that it's important not to so much have your strategy depend on timing this one specific event, because you don't know, I don't know, the pundits on TV don't know, literally nobody knows. In my opinion, your main goal in all of this craziness should be for this event to act as a wake-up call, to make you assess your life from a financial preparedness perspective at this point. How prepared are you for deflation? How prepared are you for an inflationary spiral? How prepared are you for perhaps geopolitical upheaval, etc., etc., etc.? Now is the time to do so. To provide even more nuance into my perspective here, I would say the following. Do I think that this is going to be the event, the Silicon Valley Bank thing is going to be the event for the history books, the major number one catalyst that's going to bring about destruction? No, I don't. No, I don't. I could be wrong, and I'm fine with being wrong, but no, I don't. However, I do believe that while not decisive, while not in itself a major catalyst that's going to bring about destruction of epic proportions, I do believe that it's at least a canary in the coal mine. It's at least yet another piece in a puzzle that will not end well for you. And this is the problem I have, like the idea that so few people have been accustomed to a climate where you don't necessarily want to make huge profits, where you don't want the glory, where you don't know, where you just want to survive. And this is going to be the climate. And so it's not so much you trying to figure out, to outsmart the market, to outsmart everyone. No, but rather you trying to figure out how you can put yourself in a position so that in a wide range of circumstances and in a wide range of potential scenarios, you will take hits, but you will take hits less so than most people, and you will take hits in a manner that still enables you to land on your feet. So yeah, we're already 36 minutes into this. I don't necessarily want to insist too much. I think what we're going to do is, if you have questions related to this particular topic, or maybe to the scenarios I'm referring to with respect to the bigger picture, to the bigger puzzle, then you can post your comments after I publish a video. And then I'm going to see, maybe I'm going to do a live stream at another point. Maybe I'm going to figure out another way to answer your comments. But I think this is an approach that makes sense. For now, this is it. Thank you for watching. And if you like the work I do here at 1 Minute Economics, you can support me. And you can do so by visiting 1minuteeconomics.com, a page which displays all the ways in which you can help the channel. PayPal donation, Patreon support, Bitcoin donation, buying my books. It's as simple as visiting 1minuteeconomics.com. Education, and I mean, when I say education, I really mean education as in you providing value free of charge, as in you providing value in a way that's not geared towards, these most primitive of feed the fear, the greed, get rich quick, doom and gloom. It's very, very difficult. It's maybe the most difficult endeavor of them all, to make money by actually educating people. So to make money in a way that does not involve scamming your audience, lying, misleading, being edgy, being controversial, polarizing the world even further as though there isn't enough polarization, and so on. So if you can afford to, I would really appreciate any kind of help. And again, visit 1minuteeconomics.com. There are a bunch of ways through which you can do just that. So thank you for watching the first ever 1 Minute Economics live stream. I apologize if there were maybe sound quality issues, mistakes. Maybe I wasn't always 100% coherent, because I did my best to kind of also go with the flow to a certain extent. I will try to do better next time, and suggestions are always welcome. You know where to find me if you want to get in touch. Be careful out there, and understand that as we're talking, perhaps the most crucial war of them all is the war that's going on for your minds. It's downright scary to me how much information people are assaulted by on a daily basis, and how difficult it is to make sense of it all. So I'm trying to do my little part here. It's hard even for me. So much information to process. It's hard even for me. But no matter what happens, I'm going to be here in the trenches. And hopefully you will also be here by my side. Thanks again, and be careful out there.